All right, good afternoon, everyone. Thank you for joining us. It's been a while since we've done one of these, so it's going to be a good time. We know we've got a lot of questions right now. So as always, raise your hand if you'd like to ask something live, or feel free to chat. But other than that, I'm going to go ahead and turn it over to Dave.
All right, well, welcome everybody. Thanks again. It's amazing to me when we do this. I just have to say, once in a while, I just marvel at our ability to connect with people. And it just is, I don't know, on a Zoom, and people are, I see my sister-in-law's on there in Salt Lake or Spokane. I know we have people in Arizona. It's just marvelous and all on board. So anyway, thanks for joining us. And I just think that today's technology is mind-blowing. Even if the world is upside down, messed up, freaks us out all the time, it's still a pretty amazing place. I love predictions. I hate predictions. They're ridiculous to do, but it's that time of year and here we go. But in order to have predictions, you have to really kind of stop and say, all right, what was last year like? Well, we know it wasn't a great year, but we really have to think about it from the perspective of, was it all that extraordinary? We take the year, we look at it and we get into it, and we look at pictures from the year and we see some extraordinary things, and there always are some extraordinary things. But when it comes to markets and what happened last year, I think it's important to reflect on it. And as we look forward to 2023, I think we need to really look at it with a lot of humility. And you don't get that. You don't get that in the financial press. What do you think about the market? What do you think about the market? This is going to happen. That's going to happen. Okay. So as we began 2022, we had the most amazing thing happen looking back. Wall Street does its annual predictions. And of course, I always talk about they're never really right. Well, you know what? They nailed it. They did. They said corporate profits, the hardest thing to get. Corporate profits, the hardest thing to get. Right. Because you've got all the variables in there, right? The recessions and all these things are in there. But they actually came within $1, the consensus of what actual corporate S&P 500 earnings were. A stunning achievement. Stunning. They haven't done that in 40 years. And of course, with that kind of deep insight, and then we all know the market goes up 16.5 times earnings per year, and they nail that, they give us the multiple, and then bam, they're all telling us the market will go up in 2022 about 8%, which by the way is a number they give us every single year. Blah, 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 times this, blah, 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 equals, we think the market will be up 6 to 8%. I mean, they just babble this and they all parrot each other, and they do that all the time, which is why we make fun of them. Now, does the market ever go up 8%? Almost never. They're never right. They're always wrong by some magnitude all the time. We all know that. But we play this game every year. But last year, they were just so spot on. And how did that help? Did that really help a lot? No. The market was off 20%. They were predicting 8%, and they nailed the hardest component of the predictions, which is why predicting is really silly. But we have to do it because we have to think about things in a broad sense, in a macro sense, right? And it's really more to try to find pockets of undervalued securities, if you will. So as we entered into 22, which was a really remarkable year, and it just truly remarkable, but 94% of asset classes, as you can see, this is a tie with the all-time worst, which is 2008. That is a remarkably bad year. Bonds, the safe place to play, had their worst year ever. The worst year ever for bonds. Unbelievable. It's truly remarkable. And so as we look at all these different asset classes, I don't care what you put money in, virtually every single one of them lost money last year. It really was a remarkably bad year. So let's take a look at the next one there, Jen. As we see this for bonds, it is the absolute worst year. That's pretty remarkable statement. Bonds are supposed to be safe, but they're not, and they never were going to be. That's one thing you could have predicted, not necessarily for 22, but at some point in time when you have interest rates at 1%, they won't work. They never will work because bonds are what you are going to receive the coupon of 1%. Why are we going to tie money up? And this is one of the lessons, if you will, of investing is that you have to look at this and say, my goodness gracious, the worst year ever. Could it repeat? Interest rates could keep going higher, and then you keep losing money on bonds. I don't want to own bonds. But for the first time in years, it's a possibility now that you could own bonds, because you see those returns now are in the rearview mirror. They're gone. Bonds have already lost. And as you can see by the years that they've lost, it was kind of a loss of magnitudes we've never seen before. We've never seen that. These are crazy bad returns for bonds. So as we look at it in the 70s, hey, our stocks didn't have a great year, but it wasn't their worst ever by any stretch, right? And so as we look forward and we're thinking as we're going into the next year, and let's go to the next slide, Jen. So as we think about this and we're thinking about the next year coming, this is as predictive as you can be, okay? So we know what Wall Street can't get this right. We know that Petso Financial can't get this right. By some magnitude, we're going to be wrong. And so as we think about and we look back, and it's always fun to look back, make fun, all those things, but I think we have to stop and say, wait, what do we know? What can we know about the coming year? Well, we can't possibly know what the market's going to do. Because if we look at and say we've had a 25% drawdown, and we did during the year at its low point, right? We have seen that and we hit it. So this is what the 2, 4, 6, 8, 9, ninth time that this has happened since 1960. So it doesn't happen very often. And 1 year later, only 1 year shows a loss. One. I'll take those odds. One time have we had a loss. And so when we look at things like averages, I think it makes no sense. 27%. Who cares? I mean, it's somewhere between -5 and 62%. Doesn't really tell me anything about what I should predict for this year, except maybe stocks are going to perform better than everybody's depressed feelings about it are. Maybe. Maybe, just maybe. And history says, what can we know about the market in general? Well, we know over long periods of time, there's a gravitational pull towards 10%. We also know, though, when we get drawdowns, negative returns, that we are going to have very good years sometime soon. Maybe not this year, maybe not 1 year later. But as we look at the numbers, we see over the years, the returns are positive, and by and large, they're exceptional returns, exceptional. So what we can know and what we can predict is that it's a good time to buy or own the great corporations of the world. That's what we know. And that's really all we need to know. It's not important to be accurate in the prediction. We just need to get the direction right. Boom. We're going that way. Let's just go that way. If owning stocks makes sense for the long term, and owning stocks is particularly attractive after drawdowns, why wouldn't we want to own stocks? Well, because all kinds of bad stuff happen all of the time, right? Well, let's go ahead and take a look at the next one. As you can see, people are pretty gloomy about the market. They're super gloomy. So if we want some data points to say, well, gosh, but everybody feels bad, isn't that terrible? Because consumer confidence is terrible, people won't go spend money, and so on and so forth. Isn't that terrible as a forward-looking mechanism? And the answer is no. Guess what? Collectively, this is a hard one to imagine, because collectively you feel the same way I feel, the same way everybody feels, that this country is on the wrong track. Our leaders don't know what they're doing. We're going to run off a debt cliff. We're going to go do this. We're going to go do that. Everything is hyper-focused and hyper-focused on the negative. And admittedly, this isn't a good time, but remember, markets are forward looking. So consumer confidence is like at the lows. It's horrible. In fact, a little bit earlier in 22, we hit our absolute low of all time in consumer confidence. I mean, that's horrible. But guess what the market does after consumer confidence hits these periods of time? It soars. And you can see that in the upper left box there. Some of you have seen this slide before. It's one of my favorite ones of how wrong we are, how wrong our feelings are. Our emotions are wrong about what the market's going to do. So we joke about this here, but man, Jennifer could have made $1 zillion trading on whenever I go, God, this just is terrible. I just hate this market. Because that is like the peak of pessimism for this optimist. And so I know she'll tell you a zillion times, it's like, it's not that we get this right. We don't. Okay. So, okay, let's go back to that slide because it's a wonderful slide. It's just awesome.
Hang on one sec. Let me go back.
Okay. All right.
My slide got away from me. I got click happy.
Yeah, you did. I saw that. Just nearly ruined the entire presentation.
I know, but you notice how I shut it off real quick so that wouldn't happen.
Exactly. I know.
Sorry about that.
Yeah, you just blew up. You could have blamed the computer. I should have let that go.
Yeah, I should. That's what it was. It was totally the computer.
Just a computer glitch. That's right. Anyway, and so the consumer confidence. Now let's go to the next slide though. I just want to show you that this is so incredible to think about. So we think in this predictive mode that we can go in and know what things are going to do based on, stuff around. So let's pretend since 2008, we knew all these things would happen. I mean, seriously, just imagine you knew a financial crisis of the which you've not seen in your lifetime would occur. The Lehman Brothers, meaning the banks couldn't transfer anymore. That happened. The flash crash, U.S. debt crisis. The reason I really think that's timely is guess what? That's what we worry about right now. Okay. Portugal receives a bailout. Now, why is that on your, nobody ever remembers this. I know, because it's just like another one of those terrible things that we all worried about, fussed about, whined about, but we got to do this 3 years in a row. It was the pigs nation, right? Portugal, Italy, Greece, and Spain. Now, remember, Greece has the GDP of like Vermont, okay? But what was the word of the day? It was that Greece was going to default and the world was going to go down. We even got caught in this belief that Crete, which happens to be like a rock, okay, in the middle of nowhere, that really is just the only reason it exists is for oligarchs and criminals to launder money. That's the only reason Crete exists, okay? I'm sure it's a pretty island otherwise, but that's why it is there. We were even told during that time that banking crisis there, that Iceland's banking crisis as well, just to name another one that seems laughable now, laughable like Y2K was, as a non-event, that all of this was going to take down the entire world, and we worried about it not once, but then we brought it back again the next spring, and we brought it back a third spring. So 3 times in a row, we had to talk about this. It is amazing. Like, this is the end all be all. We had Detroit, Michigan file for bankruptcy. A lady named Meredith Whitney during that time predicted a collapse of municipal bonds on 60 Minutes. And of course, she was famous at the time for whatever reason. They brought her on 60 Minutes, scared everybody. I'm sure that Whitney had put away enough money because she sure doesn't work on Wall Street anymore, to my knowledge. She just disappeared, right? Because we didn't have a nationwide failure. And all we did was we created fear and panic in old people's municipal bonds. That's it. Then we had Brexit. Brexit was going to be the end all be all, and Europe was going down. Britain was going down. That was a terrible thing. We had impeachment 1, impeachment 2. We had COVID. We all know about COVID. I don't need to go into this. Russian war, historic interest rate hikes, which we've gone through now. We had the worst bond market ever. Ever. Nobody would invest in this. This would be lunacy. If I could know the future like this, and know all of these events. And I'm not telling you, promise you, that we're just touching the surface. There's every month there's something you could go and put on this chart until it was just blood red, the whole thing. But we didn't want it to be so busy. These are all the things that have happened since 2008, and they're only touching the highlights. If you were to invest in this period, this is what the S&P 500 went from the beginning of 2008, the beginning of a 50% decline, and another 20% decline during COVID, and another one this last year. And that's where you are. And in this horrible environment that you knew you shouldn't have invested, you got almost 9% compounded return per year, just in the S&P 500. This is why people own stocks, because it doesn't matter. You don't have to predict things. We don't. And that's the hardest thing in the whole wide world. So the reason we kind of relive what happened last year and we think about this year is really to kind of think about what maybe some things that did particularly bad last year. Are they becoming more attractive because their prices are low enough? Are there some things we want to change around? But the reality is, the only thing we can know is that things are going to get better, and you should always own stocks, particularly after a price break of 20% or more. It's an always thing. You all have Franklin Income Fund. You all do. I just know you do. Because we love this as this little piece of a portfolio that kicks out consistent income every single month, has far less market volatility than the market itself. And by having this dividend, once in a while, you get a little bit of a price break. But here's a remarkable thing. We all feel like we have to have that perfect timing, like things have to be just right. And if the market's down 20, I think it's going to go down 25 or maybe 30. And it could be worse. And let's think about all the bad news out there, right? All the bad news advertisements. Let's run some more bad news advertisements. Why? Why do I want to do that? Why would I do that when markets are down? Because we already feel sickly about it. It's terrible. I don't want to own anything that's going down and the world looks terrible. Hey, market went down last year because guess what? The world looks terrible. Hello, it does. And so it went down. But when you think you can predict things, it's important to reflect on the fact that Wall Street itself collectively absolutely nailed. One of the hardest things to nail. And if you could just know what corporate earnings were going to be next year. Let's pull up that one chart, Jen, that's 16.5. I want to talk about that for just a second, because this is an important thing for us to understand. That price earnings ratios are 16.5. And this is where all of this predictive stuff comes from on Wall Street, right? And so as we look at it.
Dave, I don't think you have that one set up to go.
Oh, okay. All right. I don't have
Sorry.
it. All right. I just have to walk you through this.
You just have to do the visual.
I will. All right. So since I can talk on the radio, I have to at least be able to verbalize it. Now I can at least use my hands. Okay. So what we understand is that PE ratio over long periods of time is 16.5. And that makes me a really smart Wall Street analyst because I have a factoid out there. I know that. Okay. And now you know that. And so you're a Wall Street genius. Okay. You know the markets inside and out, and you know PE ratios average 16.5. And what I'm going to say is that presentation after presentation, some of you might have seen that presentation, is that they come out and they'll tell us that earnings are going to decline next year by X percent, let's call it 10%. And so all the smart people go around and going, okay, so earnings are going to go down 10. So we were at 120 on earnings. Now they're going to go to 110, or maybe they're going to be worse. Some will say it's better, whatever. This is the number. And then they all multiply it by 16.5. And as you look back over the years, 25 years, there's been 6 trading days that are anywhere near 16.5. That tells us nothing, The market is always more or less than that average. And we're all fixated as human beings on what the average is. Like if we go down 20, you'll hear commentators say, well, on average, we do go down on a bear market is 28%. Well, okay, that includes ones that are down 50. Is that where we're going? And that's when the fear builds and we make bad decisions. We say, oh, I got to get this timing right. So back to Franklin Income Fund. When you actually break that apart, and we looked at it since 1941, it's been around. And on a monthly basis, every time it went down 10% was the first look we took at it. Okay. Has it ever lost money over a 3-year period after it's down 10%? Well, the answer is no, it's not. As a matter of fact, the worst one was what, 8% around that. Okay. So back to the drawing board. Analysts, please go back. Tell us what happens if it's down 9 or 8 or 7 or 6. Tell us what is the low point of the drawdown that we don't have gains. It was less than 5. So we looked at it though and said, well, gosh, wouldn't it be great if you take it and you got it when it was down 10 versus down 6, because your rate of return must be a lot better. And the answer is no. It's totally marginal and it doesn't. Thanks for pulling that up. That's, and guess what? We're right in the middle of one of those, so we don't have our answer for what is the 7th time is all since 1941. But look what the returns are. An average return is just pretty tight. I think I'd be okay with 15%, even if it could have been a little bit higher. The point is the lowest ones are identical. And by the way, those are compounded returns. Compounded, not cumulative. So if I can look at an investment that, and by the way, there are hundreds and hundreds when we think about rolling 12-month periods, right? Or 36-month periods since 1941. So we've had now 20 periods, but we don't have the data for that, but there's 19 times that's happened. When we're given that, it's a gift. You don't sit around and miss it because it might become 7, it might become 8, it might become 10. We miss it when we try to be the low trade. We just like, we're sure because we feel so terrible. We feel it awful. And I don't want to invest. And so when we make these predictions of what the market's going to do, that's why it becomes a silly process where the only thing we can predict is markets will continue to be volatile. They will do better after drawdowns than they do in any other period of time. And we just had a good sized drawdown. And they do particularly good when they're down 20% or more, which we just had, or we're still in. It could go down worse. It could get worse. It could get much, much worse. Yes, it could. And it might not. We don't have to predict bottoms. What we know now, coming forward, is instead of getting 1% on a 10-year treasury, you're getting 4. Money markets are now, money markets, I reminded myself, money markets, which are traded at $1. It's always $1. They're just US treasuries, and you cash them in one day, full liquidity every day. I'm in it for 7 days. I get 7 days interest. Just like cash. Oh yeah, cash doesn't earn anything. But that's what it is. But we haven't used them for so long, everybody forgets what money markets are. Like, money market, is it tied to the stock market? We have to remind ourselves because it's been so long since we've had money markets. But they're at 4.27. Just checked them today. 4.27. That's really good for totally safe. In fact, you get ones that are 100% government guaranteed. They're backed by all government paper. It's just, we all know, right? The money markets are safe. That's a safe place to be. 4.25. It was 0 for years. It changes. That's what we can know because bonds had the worst year in all of history, which of course in hindsight was very obvious, but it was. We haven't owned bonds for over 10 years. Why don't you own bonds? For the safety of them. because we couldn't even earn the inflation rate. That's what they told us. The coupon tells you what you're going to earn. So if it says it's 1 and inflation is running 2, or we're trying to design a portfolio that you're going to get 4% cost of living adjusted income all the days of your life that you can't outlive, that won't work, putting 40% in there. No matter how many Monte Carlo simulations we run, it won't work. So you avoid them. But now we're going to say, now, wait a minute. So what's changed out here? Well, we're getting 4% plus. And now we look at corporate debt. Corporate debt, 6% plus for high quality. That's getting more interesting. But do I think over the next 3 months, 6 months, rates might go higher? I kind of do. Isn't that what the news is? It kind of pushing it higher a little bit. Will the Federal Reserve impact it? They won't. They will impact the short-term rates. Money markets. Are money markets going higher? Yep. 1/4 point in 2 weeks. That's what the Fed said. So they'll go on up to 4.5. So we're saying, get out of cash. We don't hold cash in the portfolios. We're sweeping it out if you need income. We're putting it in money markets to be a little bit safer, and we're now getting paid 4% for it. So that's great. Things have changed. We can now own some cash. We're thinking more about bonds. We're actually beginning to own them in small pieces because timing doesn't have to be perfect. Some of the income portfolios will have some things like preferred stock in there. That's why, because we can look back and we can look at the history of last year, and we're not predicting that this year bonds are going to hit a home run. Interest rates are going to do X. No, I just know we can now approach them and know I'm going to get 6% on a package of corporate bonds. That's what I'm going to get. I don't know what the price will be of them in 6 months or a year, but I do know 6% interest is coming into the portfolio to help with income. So maybe I can start owning some of those. But when we get fixed on price rather than what we're trying to do and getting income into a portfolio, we miss everything. Bonds are going to be, when a bond comes due, it is going to pay you what the coupon is. That's it. There is no gain. There's no loss. It is what it is. And when they tell you it's going to be 4% for a government bond, it's going to be 6% for a corporate bond. The only risk you have is the corporation disappears or the government disappears. I know the government's going to go under. We got to. Fine. I don't know how to manage around that. If that's the feeling, there is no management around that besides building a bunker and getting ammunition and food. Because the world ends if the government ends. It's total anarchy. There's no economy. There's nothing to manage. So I just pay no attention to that because I can't. There's nothing to do about it. So why ponder it? So what we ponder is what things are cheap, what things are dear, what do I want to buy and own, what do I want to trim some of? I don't need the top price. What I know is the greatest companies out there, Amazon, Google, you don't have to like them. They're highly profitable. They've done very well. They dominate their industries. They have giant moats around them. Sure, they can be fine. Governments don't like them. Sure, they should be broken up. Sure, they need to quit censoring people. I get all that. It doesn't have to be a love affair with them. On one hand, I can own the stock, and on the other, I can be outraged by them. These are the great companies, and some of them are down 50%. Amazon, crushed. Apple's down, 25%? Not as bad. Looks really good compared to Meta. You don't have to chase a company like Meta or Netflix because they're in high competition and they seem lost. But generally speaking, these companies are really cheap. Google has what we call a market multiple, meaning based on its earnings, it trades the same as like Procter and Gamble. Lunacy. Procter and Gamble can't grow. How many different ways can you make Tide or dish soap or diapers? You know, it's not like, wow, we had this great breakthrough in dish soap. They don't. But Google is growing and has all these, what they call moonshots. That like Mobileye, the car, autonomous car that just someday, or if they carve it out, break the company up, good. All the pieces will be worth zillions of dollars. That's what I'm saying. What happens when we get into these markets like this? Do I have to get the low trade on Google, or am I happy buying it off 40% from its highs? Is that okay? Or do I have to feel like a moron because it goes down to 45% below its all-time high? I'll take it, sold. And that's the way we think about it. And that's the predictions we're making, not what the market is going to do over the next 12 months. That's silly, and it's really a waste of time. And what I can promise you is by some magnitude, like last year, when they get all the components right, they know what's going to happen. They're not even close to what the market does. So sitting around going, interest rates are going to go up. Oh, what if that happened? What about the debt thing and all those things? We don't need to know. We don't. And they lead us further from the truth. Buy when prices break, back the truck up when they're down 20% or more. That's what all of history says. And when you find the great companies, many of which are down 30% and more, and dividend paying, in other words, I want income into my portfolio type stocks, some of them are down 20%. You back up the truck. You don't worry about tomorrow, it's down, it's up, it's this or that. Doesn't matter. You're able to get 20% more income into your portfolio for absolutely nothing. And that's what we're doing. We don't have to predict. We just react. We look at the ground conditions. We try to use common sense. And I think as a reflection of what I'm trying to say regarding common sense, as a reflection over the past 10 years, our biggest call was to not own bonds, to be 100% all in on equities. Now, different kinds, don't get me wrong. I mean, it's not everything was like all in the S&P 500. So you're just, because you can't do that in an income portfolio. But you can focus on high dividend paying stocks, things like utilities, things like preferred stocks that at times gave us price breaks we could sneak in. Closed-end mutual funds, including municipal bonds. At times where we find great bargains, they're there. And that's the kind of thing that I'm talking about. This is common sense. If we can't own a treasury at 1%, why would I? It just guarantees failure. And now we have so much going forward. Our prediction, we talk about it all the time, is that happy days are here again. People can be more secure in knowing that they're going to be able to draw 4 or 5% out of their portfolio and not run out of money no matter how long they live than they ever have been. But we don't feel like it. Don't trust your gut, run from it. Your gut is always wrong. Your gut might be right about that guy or that gal. That's why we have emotions, right? So we can be attracted to each other and we can breed more happy humans. But what we do with those emotions is we also put them into, oh my gosh, I'm afraid I'm going to run out of money. Oh my gosh, this is going to happen again. And we can't see the forest through the trees. We can't. We get focused on all the bad news and why it's going to get worse and not taking time to reflect that prices have already corrected. And what does that tell us about the future? Right now, it says we can take a lot less volatility risk, which I don't call risk, but that everybody else does. So I'm the outlier. We can take a lot less volatility risk in a portfolio and have the same results as we expected before. That is great news. So going forward, especially for income, we are more convinced than ever that it will work. It's going to work. We can have cost of living adjusted income in the 4.5–5% range that you won't outlive, no matter how long you live. It just doesn't feel like it. But prices have adjusted, and that's where we're at. And with that, I know we had some questions we wanted to share. And then if you all have some questions specific to here today, we'd like to answer those as well.
You know, I think before we get going on too many questions, Dave, I think we should take a second and explain the mechanism for the money market. We have a lot of people wonder where that money market is held and how we're managing it because they're used to seeing cash and there's no cash now. So, right. So it's quite different on how that's done. So I thought maybe take a minute and explain how we're doing that.
Go ahead. You're doing a great job.
All right. So what you'll see on your accounts now is it's actually a Charles Schwab, which you know TD was bought by Schwab. So we will eventually become Schwab. It's a money market and it will be listed with your mutual funds. So when you look at your statement, you'll have a line there that lists a Schwab money market account. For those of you drawing income, we have really taken your cash down as low as we can. Of course, dividends and interest still go into that cash account first, but we've set up, because technology is wonderful, an automatic sweep that will automatically sell your income 5 days before it's sent to your bank from that money market account. So we can get as much as we possibly can prior to that. And then you'll see it come out and go to your bank. So don't worry if you see cash levels very low and you're drawing income. We are aware and we've set it up to handle it. Okay. So it's quite nice what Schwab's or TD systems will allow us to do.
It is amazing. I mean, it really is, because we can go in and have all the dividends reinvest on a Franklin Income Fund, and then we can undo it like with one push of the button. It's pretty cool.
And so there's a lot of things, and you've talked about that a lot, right? So if we can get 4.25 and people are taking 4.25 on their money markets, it's quite nice to have a little bit of pressure taken off the equity side.
It is. And that's way you're also, if a sudden need comes up, it's not a problem to get 10,000 out to take care of it if the market's down.
Right.
It's just because it's never down. It's just going to earn 4.25, which also brings me to this point. Don't sit on cash. Don't sit on cash at the bank. Put it in a money market. If you don't want, because you're all worried about it, the market or whatever, and that's your really safe money. Listen, I just always like to put it this way. For every $10,000 that you're sitting there, it's $400 in lost interest. Okay. Why? That's better than beer money over a year. And that's, and there's lots and lots of people I know that are actually sitting on $100,000, $50,000, $100,000 and more because they're scared. And if you're scared, okay, that's your really safe money. I feel a lot better because I put this chunk in here. That's fine. But put it into the money markets because you might change your mind. And if you're really sure you're not going to change your mind, you can always go out and put it in a CD if you want. But right now, it doesn't make any sense because CDs are earning the same. They aren't at your bank, I know, but they are because we get banks all over the country in TD and Schwab. They're all getting 4, but they're not daily liquid the way your money market is. So we're not using them yet. We might when the yield curve inverted. You've heard this term. I think we should take 1 second to explain that, okay? Because it's just a term we throw out like everybody understands what that means. And the normal yield curve means on the short end, you're going to get paid less. Okay. I know it's probably backwards to you, but I can't figure it out. Okay. You can figure out what I'm saying. You get like 1% on, let's just say money market. Okay. And then if you're willing to tie up your money for a year, you get maybe 1.5, right? And then you keep on going out. That would be a normal yield curve, 10-year, 15-year, 20-year, and so on. You get paid more interest. That's a normal curve, right? If I'm willing to tie up my money for 10 years, I should get paid more than if I'm tying it up for a day. But what happens if we get an inverted yield curve? It goes like this, or usually more like that. But we literally are getting paid more on no duration, like 3-month, 6-month, 1-year treasuries pay more than 10-year, 5-year and 10-year paper and 30-year. So we have what's called an inverted yield curve. So it's a very odd thing. And we have that in really weird periods, like when the Fed just pushes rates up. But why is that? Because the market doesn't believe that interest rates are going to remain this high forever. And they just are willing to lock it in for 10 years at 4%, say on a 3.8, 3.9 today on the 10-year treasury versus 4.25 in a money market. They want the 10 years of certainty. So that's where we get these inverted yield curves. Normally, it's just an abnormal period. We think about it all the time. We don't have to predict. We just react. Okay. So right now, cash is paying a lot. Why would I tie up money longer term? There are reasons to do it, but we prefer to be in different parts of the market right now. And I already mentioned corporate bonds. Look for them. They'll be called income funds or whatever, income ETFs in your portfolio. Those are some of the changes you will be seeing, not all tomorrow, but over time, we're going to be seeing more and more of that. And my whole point is this: don't sit on that cash earning zero. Nobody throws money away, and you are, because it just, you got to keep 10,000 in your checking account or whatever, but let's not get carried away. If you want something really safe, it's okay. We're not going to argue with you that it should really be in dividend paying stocks or something. If there's a safe amount, let us know and get it parked. Okay. Someday that'll change. And that's why we actually sent the video out, what, 6 months ago?
Mhm.
It changed.
Yep.
We told you to keep your own cash. Don't put it here and pay us. We can't earn anything on it. Better than you can at your bank. It's zero. So right now, cash, it's all changed. It's all changed.
Good.
Okay.
All right. So this is a good question. Explain great companies like Verizon. They hit with so many fees. So are the great companies of the past 10 years still going to be the same on the list
No.
of being great companies?
No, everything changes. Everything changes. Okay. I used to have really great black mustache. We all change. We all change. Everything changes. We all change. The markets change. Great companies change. People change. It's the one constant, right, is change. Okay. And that's the best thing to think about. Is Google going to never be surpassed in what it does? No, I can't say that. I can say right now, it seems very unlikely that in any foreseeable future. All that I know is that 10 years ago, the corporate leaders are not the corporate leaders today. And I don't expect 10 years from now that that will be the case either. I use the Procter & Gamble example all the time. You also will note in your portfolios, we don't own any Procter & Gamble in the portfolios. We just don't see them having the same days as they have in the past. That's not that they're going to collapse. I love the income story that they've had, but I don't think they're going to keep raising their dividend as quickly. Their earnings are very, very slow growing. So they are a great company, been a great company, but are they the company that they were 40 years ago? No, they're not. They're definitely not, nor is that industry. It's being replaced by all kinds of other, quotes, soap companies. So it's not that they're not a great company. I just don't see the growth there. And even in utilities, when we're putting portfolios together for great companies, the great utilities of the past, they were run with good management teams. Okay. And I'll quickly point you, any of you who didn't see our YouTube with Jim Murchie on energy, don't miss that. If you might have to break it into pieces, but he really knows that this industry, the industry of energy. Don't miss it. It's just a great YouTube. It was a great Zoom, full of great information. But as he points out, the utilities in there, the companies that are really growing now are way different than they were 20 years ago and 10 years ago. I think it's true in all industries.
Comments on RMDs. Are they less this year?
They are, because they pushed forward. Yes, they are, just a little bit. And also your account value went down.
Yeah. And they did change the year. So those of you that thought you were going to have to start drawing at 72, if you were 72 at the end of this year, you had to draw, they moved it to 73. So they did make that change too.
You know, I'm going to put a side comment here. I relative to the markets, everybody did very well this year because we just don't take the same risk as the market does. With lots of things that just kind of, you know, cruised along. But the thing is that that's only small, if you will, consolation. I just wanted to, again, to say to everybody out there, we had a boom of a Christmas party this past year, and it was just so much fun, and nobody seemed to be concerned at all. I didn't hear any comments, and it has made us just go like, but we had a bad year and everybody's happy. And so I think everybody kind of gets it, you know, markets are volatile and you guys get it better than anybody else. And I just wanted to say that, you know, congratulations. You guys are really bright. I mean, you really are.
All right, I'm going to try to wrap this into a little bit of a shorter comment. Basically, it's talking about interest rates. Since inflation started to come down, it was at 9.1, then 6.5. And they're continuing to talk about raising rates. Should they take a pause to see what happens, or is the pendulum going to swing too far the other direction? And if I didn't answer that correctly, please add back on the chat, okay?
Well said, and it's a great question. The Fed never gets it right. They can't. They came into this with a delay. They screwed up. They said, well, inflation isn't transitory. It's embedded. And they still kept digging the hole deeper. I've commented about that many times. That's why I'm frustrated with the Fed. They should have started the October before this one. They didn't. They actually kept putting more money into the system, causing even more inflation for 6 months. before they finally started to reverse course. I think it's impossible to, quotes, have a soft landing, but I'm going to call this a soft landing anyway. I think that they're going to be able to get it close enough because there are signs inflation is definitely slowing down. There's no question about it. It's slowing down, but let's remember, we went like this and then prices. If we stay at stupid gas prices high, okay, that's still high. It's still very costly to families, but that's a zero inflation rate from here to here. And so that's what we're going to see in the numbers. We rose so much last year. Everybody's looking for it to cool down. It doesn't mean prices are going back to what they were. They're not. And we're also particularly seeing that on energy. So as we get through this period of comps, we're going to see that. So the Fed overshooting, they may have already done it. The feeling is that they have. We're going to have a light recession. It feels like it. I'm not trying to predict. I don't have to, because to me, plus 0.5% growth or minus 0.5% growth, well, that's a recession. That's just terrible. That's just absolutely terrible. And people will feel the pain of a no growth situation or a slight one. It isn't a slight recession. It's just a technical term for this economy really sucks. Okay, that's all it is, a technical term. And so I get kind of frustrated with people like, well, it's going to be this or that. It doesn't matter. It's not going to be good. So the economy is headed for a very bad 2023. There's no question about it, meaning almost no growth or a slight decline. All other things that could make it worse, we don't know. Things that happen. None of those things were predicted, by the way, on that slide earlier where I showed you a bunch of things that went wrong since 2008. In spite of that, the market went up. And we're not measuring from a high time to measure through the end of last year, which was down 20, right? We're measuring from a really bad time. So that just tells you how resilient it is. But none of that's predictable. It feels like it in hindsight. Oh yeah, the fiscal cliff. Oh yeah, there's that. Like, oh yeah, worst bond market. Oh yeah, we have all these things, and in hindsight, we think we can see it, and you can't. None of it's predictable, but of those things that we can predict and see in front of us, it's going to be a rough economy. People are going to lose jobs, and they already are. Microsoft laid off 10,000 today. It's going to continue, but it's not continuing at the local plumbing shop, is it? It's not continuing with the tree trimming company that just pruned my big tree because I can't climb up that thing. These people are working nonstop, 24/7, and making big bucks. And that's great. It's just we have an economy that's going to show some of the white collar jobs, I think, are losing their spaces out there. Okay?
Yep. All right, one more. Is there ever a danger of a company getting so big that it influences government decisions? In other words, are there companies dictating the direction of the government policy for the company's own good?
Yes, they all lobby, and they're all too big. And we all know the censorship that occurred with big tech, particularly at Twitter. Although I'm sure it's quite clear that Google was changing search engines and things like that. Those things are powerful and sad, and really, I always hate when people make things so big and, oh, look what happened in Nazi Germany in the 1930s. But that's exactly what they did. I mean, it is exactly what they did. And so we have to be careful and keep those freedoms there. And in my opinion, that's one of the really sick things about politics, lobbyists. It's just probably they're just the lowest form of ambulance chasing lawyers out there. They are the lobbyists. They just are in there lobbying these positions, whether they hurt or not the whole economy, in order to just simply propel their business forward and kill others. And so all of the big companies out there, Amazon, Google, Facebook, all called Meta, they all have giant lobbying arms, and they are far too big, and they have far too much influence. And I agree, it is a massive problem. And that's one of the good reasons too, to always be thinking about downsizing these companies if they can be broken up and not hurt them. There's nothing wrong with a big company, but if it hurts competition to a certain degree, then why not break it up into littler pieces that have a little less influence. Okay.
I think that's it. Unless anybody else has anything else.
Wonderful. Hey, everybody, thank you so much. We really appreciate you tuning in. And again, we don't know. Nobody knows what the future holds. And that is a remarkable thing. And so the less time we spend thinking about it and dwelling on the precision of it, it really helps us to just take a big picture look and recognize there's still a very great abundance out there. And if there is, then we really need to understand that corporations will figure out a way to make money and make our lives better and simpler. And yes, there's still going to be an awful lot of negative noise. Have a great rest of the day.